Hey, what's going on, folks? This is Chris at Verilo Trading. We hope you're doing great today. In this video, we're going to cover something that is relevant to operating a successful trading business, day trading business, and we're also going to answer a viewer's question they had about why we had switched over to trade US treasuries when we used to trade NASDAQ futures, micros, that is, okay? So if you enjoy this content, guys, let us know down below, leave some comments, and subscribe to the channel. If you want to learn more about the brokers we use to trade, you just need to check out the links in the description down below. On this channel, we talk about trading and trading psychology and this kind of stuff, so I hope you guys like that stuff because that's what we're going to talk about. So here's the comment from the viewer. They said, "This video is a gem. I love these videos of a simulations of trading activity, aka trading philosophy. I found your videos to be especially good in this regard. I think you are very good in drawing insights from chaotic market activity and a trader's interaction to it. If you could, I'd love to see a video on why you went from EQ or equity futures to treasury futures. I'm doing the NASDAQ futures primarily. Nothing wrong with it. I love it, but I really value your reason for change." Okay, so thank you for your comment, and I'm going to address that in this video here. As you guys know, I did trade the NASDAQ futures for around 2 years. Well, I traded the NASDAQ for around 2 years. Now, I still look at it. I still kind of trade it in my mind every now and then, but I don't really place any real money trades on it. In this video, I'm going to describe to you exactly those reasons why I decided to stop trading it. And let's get to it. So I made a little text document here where I outline some of these reasons, and I also did some math that will be helpful if you do day trading or short-term trading, how to figure out how much commissions are impacting your overall performance as a trader, depending on the kind of trading that you're doing. The first reason why I made the switch over, or the first reason why I decided to stop trading the equity index micros, because that's what I used to trade. I used to trade micro NASDAQ 100 and the micro S&P 500 index futures. Okay, the number one reason why I left that is because I found that I was seeing it in my stats. So actually, this is number 3 here. My stats were screaming to just stop scalping the micros because my stats were informing me that I was relatively close to the break-even marker in my trading. I could look at the results of around 500 trades or more, and the average profit per trade after commissions was normally something like right around break even, maybe green or red by a tick or two or a few ticks. And I just found how much the trading fees were impacting my overall result because my trading was very close to being break even. What I determined is that there was nothing really wrong with the way I was trading. In fact, I could have just traded the E-minis, the bigger contracts, and I would have been probably profitable trading those if the results had been exactly the same, because the tick value to commission ratio is drastically different on the E-mini futures rather than the E-micro futures. So the reason I stopped scalping the micros was largely because of that. My stats were basically saying, well, you're giving away a lot in commissions here and it just doesn't seem very much worth it. So we have two options. We're either going to have to go and trade the E-minis, or we're going to have to find markets with better tick to commission ratios. So I actually decided to find some other markets and first of all do some testing to make sure that my methods would transfer over well there. And it turns out that they did for the most part, but of course there's other problems associated with these markets too, which I'll try to explain to you. But again, I don't want to make this video too long. So the main reason why I don't trade the ES or the NQ, which are the E-mini equity futures, well, that's because actually the risk is too high. I'm not really willing to, take that much risk. So let's say I'm willing to work in the range of around 6-7 ticks for the ES. Let's say I take a trade on the ES. 6-7 ticks on the ES is around close to $100. I'm just not at the stage in my life and in my risk tolerance to be able to risk that much money per trade. If I want to remain consistent with my overall risk control plan, which is normally to keep my risk around 1% of my account value or less, actually. I just don't want to risk that much money in the market, There's no other way to answer that question. So my decision was to find markets where I can control risk a little bit better, and I found that in the US treasuries I can control my risk a lot better. The only issue, of course, is that there's still some issues with the tick to commission ratio, and I'll give you some examples about that, okay? The next thing that I think is very important here is regarding how these markets actually trade and how they actually operate. So I found that I personally have a more consistent read on these markets since the liquidity and volatility is not as erratic as it is in the stock market. volume feels more important in these markets, and the correlations are also more reliable. So the example is comparing US treasuries to equity indexes. It's, pretty easy to understand when you put them in perspective. So for example, the ES is an index of 500 stocks, meaning that when you're trading the ES, you're trading with traders that are doing business on 500 stocks and all of the derivatives associated with those stocks as well. You're basically trading the value of all those stocks. And if you ever wondered why the price action in the ES futures and the NASDAQ can be quite chaotic and quite inconsistent from day to day, that is because they are an index of stocks that, are all moving at the same time, which makes it pretty easy to understand why things can get pretty chaotic. When it comes to US bonds, I found the correlations to be a little more reliable, and I also found the volatility in these markets to be a little bit more consistent, in the sense that I can approach the market. I find that the volatility doesn't shift around too much. So for example, let's say I've identified that my 1 hour move or the average movement in the market for the 5-year treasury is around 3 to 5 ticks, meaning that on average this market's moving 3 to 5 ticks. Generally it stays within that ballpark for quite some time until it changes, and you might get some moments where it doesn't move that much or it moves a lot more. But most of the time it's staying within that range, that approximate volatility that you've identified. Whereas with the S&P futures, with the ES, it almost feels like the volatility can shift every 15 minutes to every 30 minutes at times. So it almost feels like it's a new market every 15 minutes, if you guys know what I mean. So that inconsistency factor, definitely is one thing that turns me off to trading the ES. So I just feel that the order flow and the volume just feels more reliable in the thicker markets like the US treasuries. Like, you see volume that's being advertised in terms of traders that want to bid and offer, and you see that on average there's a decent amount of volume coming in to match those orders. And again, of course, that changes based on the time where traders are doing business and not. But I would find that on average, they seem to be a little bit easier to read and more consistent in terms of their volatility. Okay, so that's one reason that I decided to look over and trade them more. That doesn't mean that they don't have their own issues. I've seen weird things with the treasuries too, especially lately, where we're seeing some very different price action in the shorter term bonds versus the longer term bonds. That can make correlations pretty unreliable. Now we're gonna go on and talk about a thesis that I have about trading that I think is relevant to anybody doing day trading. And I want to explain to you the impact of trading fees and how they have an impact on your trading business depending on how you operate. So the one thing that I want to stress is that this is going to depend on the way you trade. The first thing is that the longer you are holding trades for, the less of an impact generally the trading fees have on you. So, of course, if you're swing trading, if you're holding contracts for days, weeks, months, then of course the trading fees have a very small impact on your bottom line and on your overall profitability as a business. The opposite side of that is, of course, the smaller the movements you're going for in your trading, the more impact the commission is going to have on you. And this is where the problem really lies, because there's a lot of people out there that I've seen, and I've fallen into this trap, learning about, the art of price action and scalping. And the big issue is that the more you become a scalper, the bigger the impact the commission has on your trading. And it really becomes, it's actually almost impossible to be profitable as a scalper for some of the reasons that I'm going to describe to you right now. So this is what I want to share with you guys. We believe that it is easier to predict the next 1 to 3 ticks in the market compared to predicting the next 5 to 10 to 20 ticks in the market. And the reason for that is that we believe that, a skilled trader has the ability to act on price inefficiencies. Maybe not as fast as these HFTs do, but we believe that there are bigger price inefficiencies at times and opportunities where traders can capture these inefficiencies and basically scalp for a few ticks in the marketplace, whichever marketplace they're operating in. And of course, there's a number of factors that go into how the market is trading that will impact the probability of this trade that I'm describing to you about the price inefficiencies. The thesis is that we find it is easier to predict the next tick or the next 2 ticks rather than to predict the next 5 to 10 ticks. The way I look to trade normally is I will look to capture what is called the 1R movement, or the 1R price action, or the 1 volatility of the market. I don't know any other way to kind of call that. But if I look at my market, I watch it for a few minutes and I can see, okay, this market is moving on average 3 to 7 ticks or 3 to 5 ticks. I look at the S&P futures and I can say these ones are moving around 8 to 12 ticks. So generally, as a scalper, I'm looking to capture the volatility. I'm not really looking to get these big running winners all the time because, of course, it becomes a lot harder to predict how those moves are going to play out because of the way markets operate with their ebbing and flowing of the price action. So let's be fair. That's the way I think of it, is that, I want to capture 1R of the volatility. So if the volatility is 8 ticks, it's safe to say you should be going for 8 ticks. And then whatever else it gives you is considered a runner. But you're going to take off most of your position around the 1R mark, or around those 8 ticks. Now, the thing you got to understand is that if you're going for less than that 1R, for every tick that you take as a profit less than those 8 ticks, the trading fee is impacting you a lot more. And that's one thing that you got to understand. So what we think is that the retail fee structure for CME Group futures and for, basically almost all markets we've seen up until this point, and we've been trading for around 4 years, 3.5 to 4 years, and the majority of fee structures out there are just not favorable for retail traders to become scalpers. And this is why, in order to get those low fees, you have to have a seat on the exchange, or you have to have some way of reducing your trading costs. And that is the bottom line. So let's go ahead and look at some examples now. So commission example with 1R of price action. So I described to you this scenario where us as scalpers, we go for approximately that 1R, or that 1 volatility movement in the marketplace. Think of your market ebbing and flowing. We go for each rotation on average. So if the average rotation is 8 to 10 ticks, then we go for 8 to 10 ticks. Let's assume that a skilled scalper has a way of determining how much the market's moving on any given day in any given moment, okay? So let's just say 1R in the micro S&P futures. We're going to use that as our first example. Let's say it's 7 to 11 ticks. So let's say this, the tick value in that market is $1.25, meaning that for every tick it moves in your favor or against you, you make or lose $1.25, okay? And I'll put that market on the screen just so you can kind of see. So here's the S&P futures, and there we can see, for example, this market ticks in values of 1/4 at a time. So for example, 45.37 to 45.37 1/4. That price movement right there, with that 1 tick I described to you, that would yield or loss a value of $1.25 US, okay? And if you were trading the big S&Ps, it's times 10. It would be $12.50 USD, okay? Tick value for MES is $1.25, and let's say the trader is looking for around an 8 tick movement. And I wrote generous here because, what I'm trying to get across is that the market's not always the same every single day. There's some days where the market's, and weeks, this can go on for weeks, where the market is just slow, and it almost feels like the average rotation, the average ebb and flow of the market is potentially even a lot smaller than what it should be for you as a scalper with retail trading fees to make money, or even break even for that matter, okay? So like we said, the larger the movement you're going for, the less of the impact the commissions have on you. But the larger the movement you go for, the more you're going outside of that 1R movement, and you're basically becoming a swing trader, or you're looking for bigger moves. You're basically gambling more, okay? That's the way I see things. Our trader is trading MES. He's going for 8 ticks. $1.25 times 8 ticks equals 10. So the yield of that trade, profit or loss, will be $10, okay? So now let's say our round turn fee is $1, meaning that to buy one contract and to sell one contract, this trader pays $1, and that is also pretty generous these days. The formula to see what the percentage of our commission is of the profit and loss of our trade is as follows. We take our round turn fee and we divide that by the profit or loss on the trade, and then we do times 100 so we can get a number without a decimal place. In this case, so our fee is $1 times the profit or loss of $10 times 100 equals 10. What this basically means is that with the $1 fee and the $10 gross profit or loss, the trade fee has a 10% impact on the gross profit or loss of the trade. The fee is much more impactful the less the profit or loss is, or the closer it is to being break even. Here's another example. You traded X amount of times, maybe 500 times, and your average profit was 2 ticks per trade. In that same market, 2 ticks equals $2.50. The round turn fee is still $1, of course. So you do 1 divided by 2.5 times 100 equals 40%. This shows us that with this fee structure and trading result, the fees had a 40% impact on the profit we had generated. So as you can see, the closer you are to that break-even mark, the more the fees impact you. And that ties in to our overall thesis about the fact that scalpers simply are playing a rigged game against them if they're trying to trade with retail trading rates. And that is what we believe. So there's other math we did here for other symbols. We did some examples using the US treasuries here. And also giving, relative understanding of how much they move as well. So let's say a 1 hour move in ZF, which is the 5-year treasury note, is 3 ticks. So let's say you're going for 3 ticks. The yield on this trade would be $23.43 because every tick is worth $7.81 for this market. Let's say the round turn fee for this trader is $3, meaning that to buy one and sell one contract, meaning open and close a trade, they pay a total of $3. Some of that is exchange fees, some of it is broker fees, and all that combined. In this case, the trader going for a 3-tick profit, this round turn fee of $3 has a 12.8% impact on their total result of their profit or loss. Each time this trader makes 3 ticks or loses 3 ticks, 12.8% of their trade profit or loss is a trading fee. And this percentage, of course, changes depending on how many ticks they're going for. So if they're going for less ticks, that number is going to be even higher. If they're going for more ticks, then the number is going to start to go lower and it'll get eventually diluted. And that is why the bigger the trades you're going for, the longer the time frame of the trades you're going for, the less of the impact the trading fee has on you. I did an example of, let's say, for example, the trader managed to lower their round turn cost to trade ZN to $2.04 and still goes for 2 ticks on the day, for example, 2 ticks on average per trade. Now they've lowered the impact of the trade commission all the way down to 6.5%. So I would say that's a much more reasonable number, okay? But I would say, guys, in almost all cases here, going for a 1-tick profit in almost any of these markets, pretty much any of these markets, is pretty much not worth it because the commission, the trade fee, is going to be taking up a significant percentage of the yield of that trade, which is basically making it, practically impossible for you to be profitable trying to go and scalp 1 tick at a time. And the only way to get a trading fee lower enough that it can, start to make sense is if you have a seat on the exchange. And to get a seat on the exchange is just a whole nother, bunch of headaches. And of course, your operating costs for your business will increase by a significant amount, an amount that might not potentially be worth it for a trader unless they're doing a certain amount of round turns per month. The last example we had was with the ES and a round turn fee of $4 and going for a profit of 8 ticks. So the ES is the S&P 500 E-mini futures, widely traded among retail traders, institutional traders as well. So the tick value for this market is $12.50, and we're going for a movement of 8 ticks, which is a profit of loss of $100. Okay, so we're doing $12.50 times 8 ticks. That would basically be a movement of 2 points in the market. So from 45.38 to 45 and 40, that's 8 ticks. In this case, 4 divided by 100, which is the yield of the trade, times 100 equals 4%. This means that the commission trading fee is only impacting the profit and loss of this trade by 4%. Of course, that's only in theory. The trader, again, can take 500, maybe 1,000 trades, and then their average profit was only around 2 ticks per trade. For whatever reason, they had some winners, some losses, and their average profit per trade turned out to be 2 ticks. That means that over all those trades, they made an average of $25 per trade before their commission. And then when they add the commission in, the round turn fee is still $4. So 4 divided by 25 times 100 equals 16%. So you can see that, this trader made 2 ticks, fees were impacting their bottom line by 16%. If they had a lower trading fee, for example, they lowered this $4 down to $2, they would basically cut this 16% in half, which would be saving them potentially thousands of dollars at the end of the year if they're taking, if they're moving hundreds or thousands of contracts, of course. So in conclusion, the retail fee structure for pretty much all high volume CME contracts are not intended for scalping, and it may be nearly impossible to get by with operating this type of trading with those fees. You need to lower the fee. The smaller the moves you're going for, the more the fees are impacting your bottom line. If you're going for the 1R volatility, on most days, it will be too small of a move and the fee will be impacting your profit and loss by 10% or more. What's important to do now is to understand what's the sweet spot for how much your commission should be impacting your trade. I feel like 10% is still a lot. Like that means that every time you close a trade, 10% of that is already gone, meaning that you're giving away 10% of your edge at the end of the year. You're giving away 10% of your profits. That's quite a lot. And you're also paying 10% more on your losses. This means that for every trade you take, which goes for the 1R move or less, you're operating at a significant disadvantage of making money in the long term because you're giving away that much of your profit in trading fees. This is why I believe that operating a successful scalping business is probably, it might be impossible actually, unless you have access to really low trading costs and you have a very good understanding of your marketplace. Now it might be possible, but you're going to be limiting your trading. And the reason for that is because you have to pretty much avoid any scenarios where the market is offering you a smaller opportunity than what you are allowed to go for technically, right? So you show up one day and then you can see that the best and easiest, cleanest opportunities in your market are offering only 1 or 2 ticks. But you know that if you're only going for 1 or 2 ticks, your trading fees are impacting your result by sometimes 40, 50, and even more % of that. So it just becomes not worth it to even bother going for 1 and 2 ticks. You guys understand where I'm coming from? So you have to make sure that you're trading on days where there's more movement and more potential for movement. Because if you sit there trading when the opportunities are offering less volatility, you're going to be trading more. And of course, the trading fees don't change, but the movement in the market does change. Okay. So this video started off as explaining why I switched over to treasuries, but then I wanted to also cover some aspects about the overall, trading costs and understanding these things and how they can impact you as a day trader. So let me know if some of this stuff is relevant to you guys. Let me know if this helped you at all, and let me know your opinions down below, guys, and I will catch you in the next video. Take care. Bye.